If you turn 62 sometime in the last few years and you're only collecting your own Social Security check, there's a real chance the government is sitting on a second check with your name on it, and nobody at that office is required to mention it. Heads up before we get into it, this is general information, not personal financial advice, and every situation is different. Now let's get into the first form, because this one alone can be worth hundreds of dollars a month. Here's a situation most people don't realize until it's already cost them money. You call Social Security once. You sit through one appointment, maybe 20 minutes on the phone or an hour at a local office. You sign one application. You get your award letter, and from that point on, most people quietly assume the system is looking out for them, checking their file every year, flagging anything they missed, making sure every dollar they're legally owed eventually shows up in their bank account. That's not how it works, and it's not supposed to work that way. Social Security is not a service that audits your account and hands you money you forgot to ask for. It's a claims-based system. It pays out exactly what you apply for and nothing more. If a benefit category exists that you were eligible for but never filed a separate application for, it simply sits there unpaid for as long as you don't ask. There's no automatic flag on your account. There's no letter that says, by the way, you also qualify for this. There's no annual review where a caseworker goes through your file and says, you're leaving money here. The only way most of these gaps ever get fixed is if you or someone helping you knows exactly which question to ask and asks it before a deadline passes. I want to walk you through 4 specific situations where this happens most often to people 62 and older: spousal benefits, survivor benefits, an early filing do-over for people who claim too soon, and a separate income program most retirees have genuinely never heard of. Some of these can add a couple $100s a month to a household budget. One of them, specifically for widows and widowers, can be worth well over $1,000 a month in the right circumstances. And 2 of them come with hard federal deadlines that do not bend, extend, or get appealed once they've passed, no matter how good your reason is for missing them. Before we go further, here's where all of this actually comes from, so you're not just taking my word for it. The rule that a spouse can collect up to half of the higher earner's benefit comes from Title II of the Social Security Act. The rules around survivor benefits, the 12-month withdrawal window, and SSI eligibility are all spelled out in Title 20 of the Code of Federal Regulations. And every one of the forms I'm going to mention is a real, current SSA form you can search for by name on SSA.gov right now while you're watching this. None of what I'm about to walk through is a loophole, a workaround, or some kind of trick. It's published federal policy. The only reason it feels like a secret is that nobody at the counter is required to walk you through every possible category before you sign. I also want to be upfront about something most videos on this topic skip entirely. A lot of this may already be handled correctly for you, especially if you filed recently, filed in person with a representative, and filed at the same time as your spouse. Deemed filing, which I'll explain in a second, has closed a lot of these gaps automatically since 2016. So this isn't a video telling you the SSA is definitely shorting you. It's a video telling you exactly which 4 or 5 situations still slip through so you can rule them out for your own household in one phone call instead of wondering about it for years. Let's start with number 1, the spousal benefit, because this is the one that affects the widest number of married retirees. Here's the rule in plain terms. If you're married and one spouse earns significantly more than the other over their working life, the lower earning spouse may be entitled to up to 50% of the higher earner's benefit amount, not their own, smaller benefit on top of it, but up to half of the bigger number, whichever calculation actually gives them more money. This applies even if the lower earning spouse worked part-time for a few years, spent decades raising kids, and never had a job on the books, or worked a full career but simply earned much less than their spouse did. In dollar terms, picture a couple where the higher earner's full benefit is $2,800 a month, and the lower earner's own record only qualifies them for $900 a month. 50% of $2,800 is $1,400, meaning the lower earning spouse could be entitled to roughly $500 a month more than their own record alone would pay them. And it works both directions. This isn't only about wives collecting off a husband's record. If a wife had the longer, higher earning career and her husband stayed home or worked lower paying jobs, he's entitled to exactly the same 50% spousal calculation off her record. The rule looks at whoever earned more over their working life, not at which spouse is which gender. I mention that because a lot of retirement content assumes one direction, and it genuinely goes both ways under the law. Now here's the part that trips people up, and I want to be precise about it because a lot of retirement content gets this wrong. If both spouses filed for retirement around the same time, in most cases the SSA automatically compares your own benefit against the spousal amount and pays you whichever is higher. That's called deemed filing. and it's been standard practice since a 2016 rule change. So if you and your spouse filed together recently and everything was done through a full application with an SSA representative, this comparison has probably already happened. Where it gets missed is when spouses filed years apart. Say one filed at 62 and the other didn't file until 68, or when someone filed years before the 2016 rule even existed, or filed the online retirement-only application without ever being walked through the spousal comparison by a person. If any of that sounds like your situation, the form to specifically request a review or apply for the spousal amount is SSA-2, Application for Spouse's Benefits. It's a 20-minute phone call to find out whether you're owed a difference, and if you are, that difference typically continues going forward every single month. Now, here's a version of this that almost never comes up, and it applies to a lot more people than you'd think: the divorced spouse benefit. If you were married for at least 10 years and you're now divorced and currently unmarried, you may still be entitled to up to 50% of your ex-spouse's benefit amount under the exact same Title II rule as a current spouse. It doesn't reduce anything your ex-spouse receives, and in most cases, if you've been divorced for at least 2 years, you don't even need your ex-spouse to have already filed for their own benefit. You can apply based on their earnings record on your own timeline. Picture someone who was married for 18 years, divorced at 55, and spent most of those years working lower-paying jobs while her ex-husband had a long, high-earning career. Her own benefit at full retirement age might come out to $1,050 a month. Half of her ex-husband's benefit could be $1,600 a month. She's entitled to the higher of the two, and nothing about her ex-spouse's current marriage, income, or Social Security filing status changes that. The form is the same SSA-2 application used for current spousal benefits. And the most common mistake here is that people assume a divorce erases any claim to an ex's earnings record entirely. It doesn't, as long as the marriage lasted 10 years or longer. Now, here's where it gets important, because this next one is the single biggest gap I see, and it's specific to widows and widowers. Under federal law, a surviving spouse who has reached full retirement age can receive up to 100% of the deceased spouse's benefit amount. Not 60%, not 75%, up to the full amount the deceased spouse was receiving or would have received. Filing for your own retirement benefit does not automatically trigger this. It's a separate, dedicated application called SSA-10, Application for Widows or Widowers Insurance Benefits, and filing one form does not file the other for you. Let me put real numbers on this so it's not abstract. Picture a woman, 67 years old, a retired school teacher. She filed for her own retirement benefit at 63, so she's been collecting a reduced amount, let's say $1,150 a month. Her husband passed away 2 years ago. At the time of his death, his own Social Security benefit was $2,400 a month. If she has never separately filed SSA-10, she is still collecting her own $1,150 a month when she may be entitled to the full $2,400 as a survivor benefit. That's a gap of $1,250 every single month, roughly $15,000 a year sitting unclaimed, not because of fraud, not because she did anything wrong, but because two different benefit categories exist under two different forms and only one of them was ever filed. Here's the part they never explain clearly, and it's exactly why timing matters so much on this one. Social Security generally only pays survivor benefits retroactively for up to 6 months before the date you actually apply. There's a technical rule called RIBLIM that can adjust the exact retroactive amount if the deceased spouse had already started collecting a reduced retirement benefit before they passed. So the retroactive number isn't always identical to their full check, but the 6-month ceiling itself is firm either way. If you became eligible for a survivor benefit 2 years ago, and you're only learning about SSA-10 today, you cannot reach back and collect those 2 years. That window closes permanently, 1 month at a time, and there is no appeal process that restores a month once it's gone. So if you're widowed or your spouse's earnings record is significantly higher than yours, this is genuinely worth a phone call this week, not sometime next month. Now let's talk about something completely different. What happens if you already filed too early and you regret it? This is the third situation, and it's extremely time sensitive. A lot of people file for retirement benefits right at 62, sometimes almost by default, without fully understanding what they're giving up by not waiting. Here's the number that actually matters. For every year you delay claiming past your full retirement age, up to age 70, your benefit grows by roughly 8% a year, guaranteed, through what the SSA calls delayed retirement credits. Waiting from 62 all the way to 70 can mean a monthly check that's more than 75% higher than what you'd receive by filing at 62. That's not a marketing number. It's built directly into the benefit formula. If you filed early and you're having second thoughts, there is a one-time fix, and it's called Form SSA-521, Request for Withdrawal of Application. Here's how it actually works. If you file it within 12 months of your very first benefit payment, the SSA treats your original application as if it had never been filed. The catch, and it's a real catch, is that you have to repay every dollar you've collected so far, including anything anything that was withheld for Medicare premiums or taxes. Say you've been collecting $1,700 a month for 8 months. That's roughly $13,600 you'd need to repay in a lump sum. Once that repayment is made, your earnings record resets completely, your delayed retirement credits start accruing again, and you can refile later at a meaningfully higher rate, often adding hundreds of dollars a month for the rest of your life once you eventually do refile. You only get to use this once in your lifetime, and that 12-month window does not extend for any reason, including hardship or a good excuse. Miss it, and this particular door closes for good. Most people stop here, but don't, because there's a second option for a similar situation that almost nobody mentions, and it doesn't require repaying a single dollar. If you've already passed your full retirement age and you're currently collecting, you can request what's called a voluntary suspension instead of a full withdrawal. Here's the difference. You don't repay anything you've already received. Your monthly checks simply pause going forward, and your benefit keeps earning those 8% a year delayed credits until you decide to turn it back on, anytime up through age 70. There's no 12-month deadline on this one and no repayment requirement at all. It's a completely different tool than SSA-521. It's specifically worth asking your local SSA office about by exact name: voluntary suspension of benefits, especially if the repayment requirement on the withdrawal option is the thing holding you back from fixing an early filing decision. The fourth situation is a program a lot of retirees have genuinely never heard of, called Supplemental Security Income, or SSI. I want to be really clear that this is not the same program as Social Security Retirement, even though both are run by the SSA. SSI is a separate, needs-based benefit created under a different title of the Social Security Act, and it exists specifically for people with limited income and limited resources, regardless of their work history. As of 2026, the maximum federal SSI payment is $994 a month for an individual and $1,491 a month for a couple. And that number adjusts most years with the cost of living adjustment. Here's the key part that surprises people. You can potentially receive Social Security Retirement and SSI at the same time if your total countable income and the value of what you own fall under the program's limits. The resource limit is $2,000 for an individual and $3,000 for a couple, and that generally does not count the home you live in or, in most cases, one vehicle. Picture a retired man, 70 years old, collecting a modest $780 a month in Social Security retirement. Maybe he worked mostly in cash-based jobs for years and has a thin earnings record. If his only income is that $780 check and he has minimal savings, he could potentially qualify for a partial SSI payment on top of it, bringing his monthly total closer to the $994 federal benefit rate. Nobody flagged this for him when he first filed for retirement, because the standard retirement intake process doesn't automatically screen for SSI eligibility. You have to ask for it, and the form to apply is SSA-8000. Now, picture a retired couple instead, both drawing modest Social Security checks that add up to $1,200 a month combined, with savings well under the $3,000 resource limit for a couple. They could potentially be eligible for a partial SSI payment on top of that $1,200, up to the $1,491 combined federal benefit rate, depending on exactly how their income is counted. If your monthly income is limited, and this was never brought up when you first filed, it's absolutely worth a direct question, because SSI works differently from the other benefits I've mentioned tonight. It pays only from the month you apply forward, with no retroactive lump sum at all. So every month you wait to ask is a month of payment you simply never get back. I know for some of you, the idea of calling Social Security and asking pointed questions feels intimidating, especially if the last call you made felt rushed or confusing. That's completely normal, and it's exactly why writing down the specific form numbers and exact wording ahead of time helps. You're not asking the representative to guess what you mean, you're asking about a specific named form that either applies to you or doesn't. A representative can tell you in a few minutes whether SSA-2, SSA-10, SSA-521, or SSA-8000 apply to your situation using your own record, which is something no calculator or article, including this video, can do for you with certainty. There's one more situation worth knowing about, and it's narrow, but it can matter a lot if it applies to you. Specifically, if you were born before January 2nd, 1954. A strategy called the restricted application, which let a married person file only for a spousal benefit while letting their own retirement benefit keep growing at that 8% a year rate, was closed off for most people by a law passed in 2015. But if you were born before that specific date, you may still qualify for a version of that strategy, potentially letting you collect a spousal benefit now while your own benefit keeps growing until 70. If that describes you and you haven't asked SSA directly whether it applies to your situation, it's worth raising by name in your next call, because it's not something that comes up unless you specifically ask about it. So here's what I'd actually do with all of this, starting today, not next month, broken into steps so you can just follow along in order. Step 1, pull out your most recent Social Security benefit statement, either the paper one that comes in the mail or the one you can download from your account at ssa.gov, and look at exactly exactly which benefit category it lists. If it says retirement insurance benefit only and you're married, divorced after a long marriage, or widowed, that's your signal to keep going with the next steps. Step 2, call the Social Security Administration at 1-800-772-1213 or make an appointment at your local field office if you'd rather go in person. When you get someone on the line, ask 2 specific questions using this exact wording because vague questions tend to get vague answers. First, was deemed filing applied to my claim, and am I currently receiving the full spousal, divorced spouse, or survivor amount I'm eligible for? Second, if it applies to your situation, am I still within my 12-month window to file Form SSA-521, or should I be asking about a voluntary suspension instead? Step 3. If you're widowed, specifically ask about Form SSA-10 and request a written comparison of your current benefit against the survivor amount before you hang up or leave the office. Don't accept a verbal estimate. Ask them to put both numbers in writing or send you a statement showing the comparison. Step 4. If you're divorced after a marriage of 10 years or longer and you're currently unmarried, mention that specifically and ask whether a review under Form SSA-2 based on your ex-spouse's record applies to you. Step 5. If your monthly income is limited, ask directly whether you meet the income and resource limits for SSI and request Form SSA-8000 if you do. This is the one category that genuinely never gets raised unless you bring it up first. Bring your Social Security card, your most recent benefit statement, and if survivor or divorced spouse benefits apply, your marriage certificate or divorce decree, and the Social Security number of your spouse or ex-spouse if you have it. Incomplete paperwork is the single most common reason these reviews take longer than they need to, so gathering it before your appointment saves you a second trip. Write down the date of the call and the name of the representative you spoke with in case you need to follow up later. Look, the SSA isn't hiding any of this out of malice. It's simply not built to chase down every retiree and ask whether they filed every form they were entitled to file. That responsibility falls on you. And honestly, that's exactly why I make videos like this one. If this helped you figure out a question worth asking this week, consider subscribing because next week I'm walking through exactly how Medicare premiums get calculated off your tax return and why a lot of retirees end up paying more for Part B than they actually need to.